Imagine you are standing on the sidewalk right in front of this distressed 1920s duplex in East LA.
Okay.
You love the architecture, you can clearly see the potential, and you are finally ready to make a move. So you call your bank and you start that tedious, 45-day mortgage paperwork process.
Right, the usual drill.
Exactly. But literally 48 hours later, you drive by the house and there's already a sold sign hammered into the front lawn. You didn't just lose the bidding war, you never even made it onto the playing field.
And that is just a brutal realization for a lot of people. I mean, you spend your whole life building good credit, saving a down payment, doing everything traditional financial advice tells you to do.
Playing entirely by the rules.
Yeah, only to realize that in a hyper-competitive market, your money is essentially moving in slow motion. The system you were using, well, it just wasn't built for the arena you just stepped into.
Which is exactly why today we are tearing the lid off the hidden high-speed financial engine that powers competitive real estate. We are looking past that glossy, artificial surface of those home renovation television shows.
Oh, definitely. Those shows skip all the actual math.
Right. We want to understand the actual physical mechanics of how professional investors operate. We're talking about how they win bidding wars before you even get your appraiser on the phone.
How they completely bypass bureaucratic red tape.
Yes. And most importantly, how they use high-interest debt as a strategic weapon rather than, a trap.
And to ground this deep dive, we are pulling from a really fascinating stack of localized market analyses and briefs.
Yeah, these are from the spring of 2026, right?
Correct. Written by John Constantine. He works with GRO Los Angeles Hard Money Real Estate, which is this specialized lender operating right in the thick of East LA.
Real boots-on-the-ground stuff.
Exactly. These documents offer just a masterclass in the realities of localized high-velocity lending.
Okay, let's unpack this. Because framing this entire deep dive is one core concept. In the professional real estate market, speed isn't just a nice advantage to have. Speed is the actual currency. Like, everything else is secondary.
Yeah. If we connect this to the bigger picture, we really have to start by looking at the fundamental mismatch here.
Between the market and the banks.
Exactly. There's a mismatch between the realities of a hot real estate market and the glacial pace of conventional banks. The analyses use East Los Angeles as the prime case study.
So we're talking about areas like Echo Park, Highland Park, or City Terrace.
Right. When a distressed multifamily property hits the market in these pockets of Southern California, and the underlying math makes sense, it routinely receives multiple all-cash or hard money offers within 48 hours.
Just 48 hours. Think about what you're up against there as a normal buyer.
It's impossible.
It really is. Trying to use a traditional bank in a 48-hour bidding war is it's like bringing a 1990s dial-up modem to a modern high-speed fiber optic gaming tournament.
That is a perfect analogy.
Right, like you are technically connected to the internet, sure, but by the time your screen even loads the lobby, the match is over, the arena is empty, and the cash buyers have already taken the trophy home.
Yeah, and the terminology used in the local market data is remarkably blunt about this reality.
What do they say?
They say if you are waiting 45 days for a traditional mortgage approval, you aren't investing, you are spectating.
Wow. Spectating.
Yeah. A pre-approval letter from a massive institutional bank is viewed by Fellers as merely a suggestion. It is basically a piece of paper saying the bank might give you money, assuming you pass a total gauntlet of future tests.
Right, whereas a proof of funds letter from a specialized, localized lender.
That is a guarantee.
But let's break down why that traditional dial-up modem is so slow in the first place. When I go to a big institutional bank, what is physically happening behind the scenes for those 30 to 45 days?
Well, institutional banks prioritize the individual borrower's historical financial profile above all else. They're dispatching underwriters to comb through your tax returns, your W-2s, and your bank statements from the last few years.
They're calling your employer.
Calling your employer, yeah. And they're demanding written explanations for, like, a random $300 deposit that hit your checking account 2 years ago.
Oh, I've been there. It is maddening.
It is. Because they want to know exactly how safe you are, personally. Verifying all that history is inherently slow because they are essentially underwriting the person, not the property.
So if institutional banks are structurally incapable of playing this fast-paced game, the professionals have to be getting their capital from a completely different mechanism.
Exactly.
And that takes us directly into the world of short-term lending, specifically bridge loans and hard money.
Right. This is the gap financing that completely solves that 45-day bottleneck.
How does it work?
Well, the reason a specialized hard money lender like GRO Los Angeles
Hmm.
can move so fast is because the evaluation of risk shifts entirely. They are not auditing your personal tax returns from 3 years ago.
So what are they looking at?
They're looking almost exclusively at the real-time physical value of the asset itself. This is called asset-based underwriting.
Meaning they don't necessarily care if you have a perfect W-2 income.
Right, because the property is the security.
That perfectly explains the speed. I mean, the data shows a bridge loan can close in just 5 to 10 days.
5 to 10 days, yeah.
So you find a dilapidated duplex in Lincoln Heights, you call the local lender, and they send out an evaluator who actually understands that specific neighborhood's market value.
Which big banks often don't.
Right. So they issue a term sheet and you secure the asset before a traditional home buyer has even scheduled a viewing.
And the strategy behind this capital is entirely short-term.
How short?
We're talking about holding this loan for 6 to 12 months. The investor buys the property fast, fixes whatever is broken, stabilizes the building by placing reliable renters in the units, and then,
And then what?
once the property is pristine and generating income, they either sell it for a profit or they refinance it into a traditional 30-year conventional bank loan.
I see. So the hard money simply bridged the chaotic gap between the distressed purchase and the stable long-term solution.
Exactly, hence the name bridge loan.
Now, wait a minute. I need to push back hard on this because we are glossing over the cost of the speed.
Okay, let's get into it.
The analyses show that the interest rates on these short-term bridge loans sit between 8% and 12%. For a typical homebuyer listening right now, taking on a 12% interest rate sounds like financial suicide.
It sounds incredibly high.
Right. I understand the money is fast, but how does an interest rate that massive not completely obliterate the profit margin of the investment?
That reaction is incredibly common, and honestly, it is exactly where amateur investors get stuck.
Stuck how?
There is a prevailing maxim in this tier of real estate. Cheap money is often slow money, and slow money loses deals. You have to stop looking at the interest rate as a 30-year life sentence and start looking at it as a temporary project expense.
Okay, walk me through the actual math of that, because 12% still feels like it would eat you alive.
Let's run the numbers. Yes, 12% is a high annual interest rate, but you're only holding this debt for half a year, maybe a year tops.
Oh, right. It's an annual rate, but you don't hold it annually.
Exactly. So
Yeah.
you are only paying a fraction of that rate. The professional investor views the cost of this capital as just another line item in their renovation spreadsheet.
Like buying lumber or pouring concrete.
Or hiring a plumber, exactly. It's just a material cost to get the job done.
But what if the renovation stalls? I mean, this is real life. Permits get delayed, contractors just don't show up. If a 6-month project suddenly turns into an 18-month nightmare, that 12% rate isn't a minor line item anymore.
No, it's not.
The interest alone could wipe out your entire equity position.
That is the exact risk. And it is why hard money lenders don't just hand you a giant bag of cash on day one and wish you luck.
Oh, they don't.
No. These loans typically cover both the acquisition of the property and the full renovation budget. But the lender tightly controls those repair funds. They hold the renovation money in escrow and release it in what are called draws.
Escrow draws. Okay, so mechanically, how does a draw protect the investor and the lender from that 18-month nightmare?
Let's say your first construction milestone is ripping out the rotting foundation and pouring a new one. You pay your contractor the initial deposit, they do the work, and then an inspector from the hard money lender physically drives to the site in East LA with a clipboard.
To actually verify the work.
Yes. They verify the foundation is poured perfectly to code. Only then does the lender release that specific chunk of money from escrow to reimburse you.
Ah, so you aren't paying interest on the entire renovation budget from day one.
Exactly. You only pay interest on the funds you have actually drawn down as the project progresses.
That makes a lot of sense.
Furthermore, it acts as a built-in project manager. The lender's strict draw schedule forces the investor to keep the contractors on a tight timeline.
You can't slack off if you want to get paid.
Right. But let's go back to your concern about the 12% rate eating the profit margin, because you have to contrast that cost with the advantage you gain in the purchase price.
Okay, lay it out for me.
Imagine a highly motivated seller in Boyle Heights. They inherited a property they don't want. It has thousands in back taxes, and they need to liquidate it by next week.
A traditional buyer literally cannot help them.
Exactly. Because you can offer them a 10-day close with zero bank contingencies, you might secure a massive discount on the purchase price. You might get a property worth $600,000 for a $500,000.
Just because you can move fast.
Yes. So if you are saving $100,000 on the purchase price because your capital is fast, paying an extra $15,000 in hard money interest over 6 months is mathematically irrelevant.
That is wild to think about.
Novice investors will obsess for weeks trying to shop around to save 0.5% on an institutional loan. But if waiting for that cheaper money causes you to lose a property with $100,000 of built-in equity, you didn't save money. You lost a fortune.
That completely reframes the concept of debt. I mean, you aren't paying for the money, you're paying for the speed.
Precisely.
But it is not just about the timeline, is it? The physical condition of the property itself dictates why these investors use hard money, because a traditional bank literally will not lend on the types of properties professionals target.
And this creates a massive structural advantage for the professional investor. To understand why, you have to look at the unique housing stock in areas like Boyle Heights, El Sereno, or Lincoln Heights.
Which is pretty old, right?
Very. Much of this housing stock dates back to the 1920s and 1930s.
Beautiful historic structures for sure. But they are plagued by a century of wear and tear. You're dealing with 100-year-old plumbing, dangerous knob and tube electrical wiring, and just decades of deferred maintenance.
And this is where we hit the critical choke point of traditional finance.
The banks tap out.
Totally. Conventional institutional lenders adhere to strict property condition guidelines set by massive secondary market entities like Fannie Mae and Freddie Mac. Big banks don't keep your mortgage. They sell it to these entities.
Right.
And Fannie and Freddie demand that a property meets strict habitability standards before they will back a loan.
Meaning, if a house in El Sereno is missing a functioning kitchen sink, or the roof has visible water damage, the conventional bank will run screaming.
They will deny the loan outright no matter how good your credit score is.
Just because of a sink.
Just because of think. They require a turnkey home, or at least one that is immediately livable.
Wow.
Hard money lenders, however, base their funding on the ARV, the after repair value.
Ah, so they are financing the vision of what the property will become once you execute your renovation plan.
Exactly. Not the dilapidated, sinkless state it is in today.
Here's where it gets really interesting. This strict bank requirement basically builds a protective moat around the professional investor.
How so?
Well, because the moment a house lacks a functioning kitchen, you immediately remove 95% of the general public from the bidding pool. Every single regular family relying on a standard 30-year mortgage is legally disqualified from making an offer on that house.
That is a brilliant way to look at it.
Right.
It is basic supply and demand.
Right.
By removing the masses from the competition, you remove the bidding wars that drive up prices. The professional investor secures a significantly better purchase price simply because no one else is allowed to buy it.
It's like a VIP section, but for distressed homes.
Exactly. An amateur looks at a 1920s house with a gutted kitchen and sees a disaster to avoid. A professional looks at that exact same gutted kitchen and sees a total lack of competition.
They see a forced discount.
Yep.
And the market data highlights some specific trends driving this strategy in Los Angeles right now. It is not just about fixing old plumbing. It is about leveraging where the city infrastructure is actually moving.
Yes, the analyses point heavily toward transit-oriented neighborhoods.
It's like near the metro.
Exactly. Expansions like the Metro L line and local infrastructure improvements are rapidly driving up property values.
Yeah.
But the absolute gold mine right now involves zoning, specifically ADUs.
ADUs, those are the accessory dwelling units.
Yeah.
The secondary houses, the granny flats, whatever you want to call them, that you can build in the backyard.
Yes. Recent zoning updates by the Los Angeles Department of City Planning have made adding ADUs to existing residential lots significantly easier. But again, you run into the traditional banking wall here.
Because banks don't like speculative construction.
Exactly. You cannot usually get a conventional mortgage to buy a dilapidated house and simultaneously fund the speculative, ground-up construction of a brand-new unit in the backyard. The bank's risk department would reject it instantly.
So how does the investor actually execute that dual project mechanically? Like, how do they fund both at once?
With a specialized bridge loan, the investor buys a single-family home on a large lot. They use the first phase of escrow draws to rehabilitate the main 1920s house, bringing it up to modern standards.
Okay, fix the front house first.
Right. Then they use the remaining draw funds to clear the backyard, lay a new foundation, and build a brand new ADU from the ground up.
Meaning you just took a single plot of land with one front door and turned it into two income-producing front doors.
Yes. And once both units are finished and rented out to tenants, the asset is considered stabilized.
And that's when you go back to the bank.
You got it. The investor then goes back to the traditional bank, points to this beautiful, fully permitted income-producing duplex, and easily refinances the whole package into a safe, low-interest, long-term conventional loan.
So the hard money lender gets paid off.
The hard money lender is paid off, and the investor holds a highly profitable asset.
So what does this all mean? It flips our traditional understanding of financial risk completely on its head.
It really does.
Everything you and I are taught as normal home buyers, run away from high-interest debt, avoid houses that need gut renovations, definitely don't attempt speculative construction. These are the exact mechanisms professionals use to eliminate their competition.
And secure assets at a massive discount. What's fascinating here is how this entire ecosystem requires a fundamental shift in mindset.
From the borrower, you mean?
Yes, the analyses make a very pointed observation. Debt scares amateurs. Professionals use it as a tool.
Oh, that's good.
The way a professional views equity is entirely different from the average homeowner.
Right. There is a line in the data that perfectly encapsulates this. It says, "Your house is a bank vault. Open it."
I love that line. Think about the average homeowner in a rapidly appreciating market like Southern California.
Okay.
If you are listening to this, you might actually be in this exact position. You bought a house 15 years ago, and thanks to market appreciation, your Zillow estimate says your home is worth a fortune.
You're a millionaire. On paper.
Exactly. You have massive paper wealth.
But you can't buy groceries with paper wealth. You can't fund a new business with a Zillow screenshot. The money's just trapped inside the drywall.
And amateurs stare at their estimated home values online and do absolutely nothing. Professionals, however, use a mechanism called a cash-out refinance.
How does that work in this context?
They go to a lender and replace their existing mortgage with a new one for a higher amount, based on the new appreciated value of the property.
And the bank just gives them the difference,
The bank hands them the difference in tax-free, liquid cash.
which they then deploy. I mean, they use that extracted equity to fund business operations, fix up their other distressed properties, or use it as a down payment on their next acquisition.
Right. They unlock the vault to snowball their portfolio.
But even with cash in hand, there is a mathematical wall here, isn't there?
What do you mean?
Well, if I use that extracted cash to try and buy my fourth or fifth rental property, a traditional bank will look at my personal W-2 salary and eventually cut me off.
Oh, absolutely.
They will say, look, your personal income isn't high enough to support 5 mortgages, so how do professionals bypass the personal income trap?
They bypass it using a loan product specifically designed for scaling. It's called the DSCR loan, or debt service coverage ratio.
DSCR.
This is arguably the most powerful tool in the professional's arsenal. A DSCR loan completely severs the link between your personal W-2 income and your borrowing capacity.
Meaning my personal salary is no longer the ceiling for my investment potential.
Exactly.
So how does the lender evaluate the risk then, if they aren't looking at me?
Instead of looking at your personal tax returns or your debt-to-income ratio, the lender looks entirely at the cash flow potential of the investment property itself.
The property has to pull its own weight.
Precisely. They run a simple mathematical formula on the asset. If the new duplex you want to buy is going to conservatively generate, say, $4,000 a month in rental income,
Okay.
and mortgage payment, taxes, and insurance on that property will only cost $3,000 a month.
Then you have a $1,000 surplus.
Right. The property produces enough cash to pay for its own existence. It covers its own debt service.
So as long as the rent is higher than the mortgage, the lender doesn't care what you do for a living.
They don't care at all. They will approve the loan based purely on the math of the asset, regardless of whether your personal W-2 says you make $50,000 a year or $500,000 a year.
That is incredible.
It is how investors scale from 2 properties to 20 properties without their personal income ever becoming a bottleneck.
When you lay it all out, the 5-day bridge loans, bypassing the kitchen sink requirement, extracting trapped equity, and scaling with DSCR loans, it really is a masterclass in challenging conventional wisdom.
It really is.
We started by talking about the agonizing 45-day wait at a traditional bank. But by shifting the focus from the individual's past to the asset's future, the entire game changes.
Completely.
You stop asking, am I qualified enough to appease this bank's committee? And you start asking, is this asset profitable enough to fund itself?
The entire system is meticulously designed to bypass the traditional choke points of institutional finance.
And that brings us back to you, the listener, because even if you are absolutely never going to buy a dilapidated 1920s duplex on Whittier Boulevard, understanding this dynamic is incredibly important.
It applies everywhere.
Yes, it teaches us a fundamental lesson about the systems we navigate every day. The standard way of doing things, like traditional banking or even traditional career paths, is usually built for the masses.
Right.
It is optimized for institutional safety, predictability, and, bureaucratic easy processing. It is rarely optimized for your speed, your agility, or your unique opportunity.
Which leaves us with a really provocative thought to consider.
Let's hear it.
We spent this deep dive talking about how professionals value real estate based on its after-repair value.
Right.
They finance the vision of what something can become, not the broken state it is currently in.
Yes.
Apply that framework outside of real estate. Where else in your life, your career, or your relationships are you evaluating opportunities based entirely on their current dilapidated state?
Oh, wow. Are you walking away from an incredible career pivot or a raw, talented team member just because they are temporarily missing a functioning kitchen sink?
Exactly. If you only ever look for turnkey, fully approved opportunities that meet every conventional standard, you will always be stuck competing with the masses,
Waiting in that 45-day line.
waiting in line. Sometimes the most lucrative move you can make is to stop demanding perfection today and start investing in the after-repair value of tomorrow.
You have to finance the vision. That is definitely something to think about. Thanks for joining us on this deep dive.